Okay, this is the instructions for completing the statement of cash flows. Let me begin by talking to you a little bit about this report. I know that probably in your 211 class, you did not go into great detail in creating this report. So it's imperative that I walk you through it. It might take me a little bit longer for this one because I'm going to explain the reason for the adjustments. So let's first talk about the big picture. So the main point of this report is to keep your eye on cash. So this report is necessary because if you go back and look at the income statement, this is based on accruals. So it's all the sales that were made in 2020. Some of those sales maybe didn't get collected until the 2021 year because they're in accounts receivable. So you've got some sales in here that don't involve cash. Okay, it's actually in here in the roasting is where we have accounts receivable. So whatever's in accounts receivable has got to be backed out of that number, right? So if you have an increase in accounts receivable, you're going to back that out of that number. If you have a decrease in accounts receivable, you're actually going to go the other way with it. I'll explain more about those adjustments as we get to them. Now, when you look at the costs, you got the same idea, same problem here. So some of these expenses that you see in this list haven't been paid for yet. So we've got part of the roasted beans, we've got 1 month worth of purchases that we made that's in accounts payable. We have not paid it yet. And if this is the statement of cash flows, right, if this is the statement of cash flows that we're working on back here, then we got to make adjustments for those kinds of things. So that's why you see a lot of this adding and subtracting going on when you take the net income. Because remember where net income comes from the income statement. So that is where you start. And the problem with this number is that there's things that are being recorded here that do not involve cash. So let's go ahead and pull that back. All right, so let's make our first adjustment and we'll talk about what's going on here. All right, we're going to add back the depreciation expense. So this is the expense, not the accumulated depreciation, but just the expense, because we started with this number, which is for the year only, net income. And to get to this number, we subtracted the depreciation that was recorded for the year, okay? So we're going to add it back because depreciation is an adjusting entry. It's not a cash-related entry. So we're going to go over to the depreciation schedule and get the whole amount, which is right there, right? Because that's not a cash flow. And that's for the entire year for all depreciation. Right, now we got another problem here. Let's go back to the income statement. So what we're doing here right now, these two items are on the income statement. These items you see here are going to be in the working capital section of the balance sheet. So we got this one other one. Let's go look at it. All right, so over here, you got interest income from investments, right? And if you go to the investment schedule, you see them too. There they are. There's the interest income. These were amounts that were earned on our investments, but we haven't cashed them out yet, so they're not actually cash flows. So look, that was added. It's positive, added to net income. So to get rid of it, I got to back it out. So I'm going to hit equals, and then minus. I'm going to go over to the income statement and grab that, and that'll back that out. All right, so those are the only items on the income statement that I need to grab directly, right? So 100% of the items that were on the income statement just need to get out of there. Right, so that removes them from net income in a sense. Right, now notice that this list right here, I'll color it up for you. This list is all current assets. And then notice this list is all current liabilities. So the thought here is that if these current assets increase, so let's go with inventory. If inventory increases, that means you got to spend the money to pay for that. So that's going to be a cash outflow on this report. So the idea here is if any current asset account increases during the year, that increase is treated as a cash outflow, a negative outflow in the statement of cash flows. So here's how we kind of do that. It's a nice little trick. You can go to your balance sheet, budgeted balance sheet, and start with the year before for that account, the accounts receivable, and then subtract the next year. Okay, so what we have there is a positive 4,700, and I hope that makes sense. Let's go back and look. So from the end, which is actually the beginning of 2020, that's the beginning of 2020 right there. This is the end of 2020. So during 2020, accounts receivable, our plan is that it will go down. And how is that possible? Well, we're hoping to reduce the number of days outstanding for our receivables, DSO, days sales outstanding. To do that, our customers are going to have to pay more cash, more readily, more often. So we would expect our cash to go up on the statement of cash flows. Okay, so if you make additional investments in any of these things, it's going to take cash to make it happen. If you decrease your investment, you're going to free up cash flow. That's the idea. Now, to keep things easy for us, I set all those current assets in the same order they are on the balance sheet. So all you have to do is pull that down to the bottom of the blue section, because those were all current assets. And if you remember, the balance in supplies and the balance in the prepaid did not change, and the two balances in the inventory accounts went down because we're trying to shrink the number of days we have on hand. So what we got there is, because we're getting more efficient, it frees up cash flow. We don't have to invest our cash flow in these current assets and sit and wait for cash. We're actually going to get the cash. We're going to free it up, okay, by reducing what we have invested in current assets. Now, the liabilities side, these green ones, these are all the current liabilities you have. In the green section, that works the other way because it's on the other side of the balance sheet from cash. So if you build up your liabilities, which these are current liabilities, if you build them up, that actually serves to generate working capital, right? So it actually adds to the cash that you have. Let me explain that another way. If let's say you borrow money and that account goes up from one year to the next, that's going to give you cash. So cash goes up and liabilities go up. And then vice versa. Let's say you pay down your accounts payable, you reduce the amount of payables that you have outstanding. That's going to take cash to make that happen. So if accounts payable goes down, cash is going to go down. So to do that, a little shortcut is equals, go to the balance sheet, start with the first one. So this time you start with the 2020 number and back off the 2019 number. So you flip that over, which changes the sign. And I want you to look at that. Okay, so this is going to take up, I want to make sure I reference the right. So 25, let's go double check. Yep, 25. Okay, so look, this is going to decrease because we're going to pay our bills a little faster than we were. So this is decreasing what we've got in accounts payable. And in order to reduce what we owe, it's going to take cash flow to make that happen. So that's why you see cash going out, right? And all of these, except for this one, let's go back and look at that. That one went up, right? This balance went up. So you're going to owe more in taxes, which gets added into cash. That increase in liability creates an increase to the cash account relative to where you started with net income. This is tricky stuff. All right, now capital expenditures. This is 100%, this is investing activities. This is all about PP&E and any other long-term assets that you have, like investments, okay? So if you remember on the balance sheet, we don't have any change in PP&E. Don't have any change. So we could grab that, again, you start with the 2019 and go to the 2020. You could grab that difference right here. So this minus this, look, they're the same. So you're gonna get a 0, which is right. We did not make any purchases of property, plant, and equipment. Okay, then the increase in investment, you gotta be careful here because we already picked up the increase that was due to the interest on the investment right there. The only thing you wanna pick up here is money, cash that we've spent, right, to increase the amount of investments that we have. And we did spend another 10 grand this year, 2020. So equals then negative sign, go to investments, grab that 10 grand we put in, okay? And there you go. Okay, that's it. Now this section is for financing activities. This is where you account for any cash flows related to borrowings. So this is only the principal, not the interest. And also stock transactions. And if we had dividends, they'd be in this section too, right? All right, so there's a couple of ways you could get this. You can go over to the balance sheet like this and take that minus that. Notice when I'm on the liability side, I always start with the 2020 amount and then subtract 2019. That's fine. Look, that's also the same number right here. Yep, right there. Now let me back off the decimal. Same number. And what is that number? That's the principal added together that got paid in the year 2020. So that's the cash that got paid in the year 2020. That's what that is. So you could get that either way. I was trying to be consistent using the balance sheet there. Same thing here. Stocks equals, go to the balance sheet. It's still $1 million, right? There's no change. So that's 0. Okay, now to get the net change of cash, you got to bring the 3 sections together. So this is the first section, and then add the second section, and add the third section. Okay. Okay. Now the beginning cash balance for 2020 is the ending cash balance for 2019. So I'll reference that. And then you add these 2 pieces together. Okay, 132, 627. If you look at your balance sheet, it's off $1. That's okay. We don't worry about $1. It's close enough, right? So it does match with what you have over there on the balance sheet perfectly well. Okay, right there. So that's a way to double check your work and make sure that you got it right. So that's perfect. Okay, the last video, I will do the last tab, which if you notice, I'm going to just go over here. I'll do these last 2 tabs. We got ratios and we got a bakery analysis tab to do. So I'll do those together in the last video.